Behind every recent price hike at the Apple Store is a severe imbalance in the industrial hardware market. The memory chips required to power a single smartphone are now in direct competition with the demands of massive industrial-scale data centers. The global supply for memory and storage chips, specifically DRAM and NAND, is an oligopoly. The entire market is dominated by exactly three titans: Samsung Electronics, SK Hynix, and Micron Technology. Right now, the AI companies possess the deepest pockets in the economy. They need massive quantities of memory to train and query their models, and they are outbidding consumer technology firms for every available bit of capacity. Take a look at this chart mapping the industry's recent profit margins. In 2023, SK Hynix was losing billions of dollars, and Micron was cutting 15% of its staff during an industry downturn. But on the right side of the graph, the sudden shock of AI demand has pushed Micron's gross profit margins to a record 80%. As we expand this graph to track stock performance, you can see how this demand shock has launched the valuations of the three major titans, along with Sandisk and the broader DRAM ETF. These have become crowded, high-premium trades. The AI boom has created a rigid supply bottleneck. For the consumer, it means paying a premium at the register. For the established chipmakers, it means capturing record-breaking margins from a limited pool of hardware. With demand this high, the market would typically respond with rapid expansion. However, the major memory chip producers are cautious. Burned by past boom-bust cycles, they are keeping their capital spending conservative to avoid creating another supply glut. Even when governments step in, the timelines are long. U.S. lawmakers have approved tens of billions of dollars in grants and tax credits under the CHIPS Act to expand semiconductor manufacturing on American soil. This timeline shows the core physical problem. While the demand spike is happening now, Micron's new facility in Idaho won't open until mid-2025. Their massive plant in New York isn't scheduled to start production until 2030. These fast-moving technological shifts are currently restricted by the slow-moving physical realities of concrete, steel, and new construction permits. Currently, the only entities capable of providing a quick, partial fix to this global shortage are rapidly expanding Chinese chipmakers like CXMT and Yangtze memory technologies. But national security policy creates a hard barrier. Strict U.S. rules and the threat of tariffs are designed specifically to prevent American companies from partnering with these Chinese firms. Domestic heavyweights like Micron are actively lobbying Washington to enforce tighter restrictions on Chinese partnerships. The goal is to protect technology secrets and preserve the market share of suppliers based in allied nations like South Korea and Japan. These policies have real-world consequences for consumer hardware. In 2022, Apple worked with a Chinese supplier to source flash storage for the iPhone, but lawmakers forced the company to abandon the deal entirely. Trade walls are effectively compressing the memory market. This locks Western technology firms into a physical bottleneck and forces capital to seek out alternative ways to play the global demand for silicon. Global capital is finding workarounds. Major PC makers like HP are currently negotiating to use Chinese memory chips for products sold in Asian markets, bypassing the trade restrictions that apply to Western inventory. For investors, this divide is sparking a rotation trade. Institutions are looking to capture China's domestic tech expansion by backing a new wave of initial public offerings. The first major target is CXMT. They are China's top DRAM maker and the fourth largest in the world. After reporting a year-over-year revenue jump of over 700% in early 2026, they are moving toward a multi-billion-dollar IPO in Shanghai. The second target is Yangtze Memory Technologies, or YMTC. They are building 3 new factories to double their capacity by 2027 and are expected to file their own formal IPO application shortly to fund that expansion. Because they operate within a domestic ecosystem, these Chinese companies represent a growth factor that exists parallel to the walled-off, bottlenecked Western market. This pattern of shifting capital toward high-growth domestic alternatives is expanding throughout China's heavily subsidized technology landscape. Consider Unitree, a pioneer in humanoid robotics. As a primary manufacturer of the hardware required for the next frontier of AI, their recent IPO approval offers another avenue for capital to enter the Chinese tech sector. This strategy is gaining institutional traction. A recent note from Goldman Sachs suggests investors may want to rotate out of overcrowded, high-valuation U.S. tech stocks and into these Chinese laggards, firms with clean positioning and high domestic demand. Until new American and allied manufacturing plants finally begin production in the 2030s, the global supply of memory will remain capped by physical construction times, making these isolated Chinese growth vectors a primary focus for those navigating the geopolitical divide. If you found this breakdown of the memory crisis helpful, make sure to like this video and subscribe to the channel for more deep dives into the economics of the AI age.